Good evening, Traderade family. Horse and Mayhem here for another midweek update. It is Wednesday, September 21st, FOMC day. Lots to talk about, but we're really going to narrow our scope today to be really specifically about the Fed, what they said, what's on the horizon, and what happened in the market. So without further ado, welcome my co-host, Mr. Mayhem, and I'm going to turn things over to you. Walk us through this crazy day that we saw today.
Hey, Horse. Thanks, and nice to be here. Really an interesting day that we saw both from the Fed and how the markets reacted to the Fed. I'm going to leave the latter part to you in terms of the equity markets, but let's talk a little bit about what the Fed did and why it mattered. Before I even bring up the first chart, the biggest thing is that Powell is being very clear here that he has zero intention of turning back from the very aggressive posture that the Fed has put forward. They do not want inflation to be an issue that continues to erode economic vitality. Because if inflation gets out of control, it's much, much worse than high interest rates. And while high interest rates certainly threaten a large component of the global economy because there is so much debt that is denominated in dollars that is rate sensitive, the other side of it is that if intractable inflation manifests and it becomes structural and it runs out of control, that can be much more deleterious to the economy, to society as a whole. The Fed has a limited set of options because its tools are all directed at destroying demand. So all they can really do is raise the cost of capital. They can remove liquidity from the financial system. They can make it essentially more punishing to be a debtor. And that's exactly what they've been doing with one of the fastest velocities of interest rate hiking and tightening of their balance sheet that we've ever seen on the balance sheet ever. On the interest rate side, it's definitely historic. And maybe after today, it is the fastest velocity in terms of the rate of change from where they were at 0 to 0.25% to where we are now. So let's look at this first chart here. This is the probabilities for the November meeting. The reason I'm going to bring this up is I'm going to use it as foreshadowing. So we now have a policy rate that is 300 to 325 bips. That is a pretty big departure because going into today, it was 225 to 250. So the rate of change here is incredible. We've had 375 bip hikes in a row. We have an increase of 225 bips that has happened across just 3 meetings. And that's incredible. So while a lot of folks looked at that July press conference from Powell and said, they've been doing so much aggressive hiking, they're getting into QT, it's going to accelerate in September, maybe we're going to see a pivot soon because he's saying that he's data-driven and that he's thinking that they're closer to achieving a neutral rate, a completely different Powell emerged from Jackson Hole and made it clear in no uncertain terms in a speech that we now found out, his original speech he scrapped. He had this 8-minute speech where he eschewed any press conference and just put this out there where he said, look, I'm going to conjure up the image of Paul Volcker and I'm going to put the fear of God into the market. And that day we had, a 4% down day? It was pretty incredible. And that alleviated the narrative potential, that sort of right tail of this idea that the Fed pivot was coming imminently. But we still needed a little more convincing. And so then we got the August CPI data in September on lucky 13th. And we had another 4% down day thereabouts on the SPOOs. And that was because the final nail in the coffin of transitory inflation had been put in, at least for now. Why does that matter? Because the kind of rally that we saw from June, from those July lows, was predicated on those two narratives, peaking inflation and a pivoting Fed. So now we're seeing the exact diametric opposite of all of that. Now we have inflation that is showing some degree of structural resilience, both here and abroad, and a Fed that has made it abundantly clear that they're not even close to done with what they have to do insofar as both the rates and their balance sheet. And Powell's press conference today, as well as the press statement from the Fed, were both quite hawkish. He did leave some room to say that in the future, eventually we will look at a lower interest rate regime. But if you look at what they put out there with their dot plot. I know you didn't want to see any of that on Twitter. If you look at what's out there in their dot plot, what they're projecting, they're saying they're going to get to 4.4% by the end of this year. That's an incredible rate of change. Again, right now, after today's enormous interest rate hike, we're in a policy range of 3 to 3.25%. So they're saying we're going to take this up another 140 basis points, or basically 75 in November and 50 basis points in December. So we're looking at another 75 bips at the next meeting, which is just over a month away. And then another 50 in December to celebrate Christmas, so that everyone's credit card bills go up at the time of year where they're spending the most money. This is a great way, by the way, to reduce inflation. This sort of shock and awe campaign of increasing the cost of capital, constraining liquidity, it's going to have a desired effect. That side of the toolkit where they can affect demand, it's going to work just fine. It's going to subdue demand. We will see a recession, because 2/3 of economic activity in the U.S. is from consumer demand. You subdue that demand, you get drops in economic growth commensurate with that reduction in demand. That leads us to a recessionary environment. And you could say we're already in a technical soft recession because we've had 2 sequential quarters of negative GDP prints. So I think what's important to look at in the chart that's on screen is we're already at 300 to 325. Coming off of a year where we started at 0 to 25. And now we're looking at another meeting where there's a 63.5% probability that we see another 75 bip hike. I don't think it would shock the market, but I do think the market has to reprice risk. One of the themes here is risk premiums are continuing to rise. Rates are continuing to rise both in real and nominal terms. And that means that risk assets, particularly those of the rate sensitive and long duration risk variety, have to take a haircut. It's just how these things work. And I don't see the Fed coming around and saying, you know what, I really didn't mean for the S&P to go down so far. We take it back. We're going to stop raising rates. We're going to stop running off our balance sheet. I think that this is a Fed that is a one policy central bank. And that policy is price stability. When we look at the next chart here, these are the probabilities of meetings going all the way out until Christmas of next year. And what I find fascinating about this chart is it's a little bit more aggressive, perhaps, than what we've even seen going up to the last couple of weeks. So if we remember back to June, if you look at an S&P chart, you can see that the year lows were made in June. At that time, the terminal rate was seen at about 400 to 425 bips. Right now, the terminal rate is seen at 450 to 475 bips. We've got a 2-year note that's now trading over 4% yield, and we have a yield curve inversion of over 50 bips. And they're still pricing in 450 to 475. So what this is saying is Fed funds futures see this Fed as being particularly aggressive, and that they believe the Fed now. This is not jawboning. They are really trying to communicate to the market that they're going to be aggressive. You need to get out of the way. And as we discussed earlier on the Crudelli show, you know, this is a Fed that you don't fight. You don't fight the Fed ever, but particularly this Fed. And in that sense, it means if you're long, you expect losses or you convert to cash, because that's essentially over the longer term of this policy trajectory what we can reasonably expect. If we hit 4.5 to 4.75 and we see the run-off rate of the balance sheet approaching $1.1 trillion, you're going to see a lot more retracement in risk assets and bonds and real estate and in things like crypto. There's no other way around it, because you're making the cost of capital appreciate. You're removing liquidity from the global financial system. By virtue of doing that, you're raising risk premiums. And that means all these risk assets need to see lower prices.
Yeah, and I'll admit, as you transition to this next slide, I was definitely, for our longtime listeners know, one of those people very skeptical of the Fed actually bringing the heat, right? In my personal opinion, I think we've seen one of the most dovishly hawkish Feds, if that makes sense, that I can remember, that really did care about the markets. But this last month has been relatively eye-opening, not just Powell sticking and doubling down on his narrative, but even hearing something like Kashkari's off-the-cuff remarks about being happy, I'm quoting there loosely because I can't remember the exact words he used, but that my point is that's not language you hear very often with a Fed president speaking openly about being happy to see the market go down. So it was very clear that's what they want. And you've been saying that all along. I've been a skeptic, right? Wondering, well, what great global catastrophe will make them pivot? But it does appear they're pretty serious, right? So I think the last month has been pretty humbling to folks like me that were sort of not exactly believing them. And then now you're seeing they seem pretty serious. I think it's safe to say they seem pretty serious.
And you nailed it. He used the exact word happy. He said, quote, "I was actually happy to see Chair Powell's Jackson Hole speech was received. People now understand the seriousness of our commitment to getting inflation back to 2%. Now, when the Fed talks about inflation, they measure it through core PCE. Core PCE is over 5%, so that means they've got a ways to go. And Mester recently said before this meeting that she believes that we're not going to see inflation at 2% until 2024. So that if that gives us any sense of a time horizon, it means we've probably got at least a year and a half to 2 years worth of tightening policy, of high interest rates staying high, and of the balance sheet running off unless and until they either reach that policy goal, which I think is maybe a little unrealistic, or they break something really, really big, which I don't think they're very close to doing, but it will happen. I think we are running a much higher risk of financial instability. We might have a somewhat less leveraged world in certain key areas like banks, but there's plenty of leverage in the balance sheet of lower income homes, of less wealthy homes, of triple B rated and lower corporations, and of governments around the world, especially those that have large tranches of dollar denominated rate sensitive debt. So I think that eventually it does cause the dam to break, but we're not there yet. We'll know when we're there, because we haven't, and I'm sure you'll speak to this as well, but we haven't seen anything resembling disorderly selling.
No,
we haven't seen panic.
No, it's been a pretty steady grind.
And that's telling us we're not near the bottom. I mean, the last leg down of almost every bear market I've ever seen turns to fear and panic. And I'm not saying that this bear market has to do that, but if it's like the others, the disorderly deleveraging phase typically happens when we see both institutions and retail dumping at market. We haven't seen that. And in fact, retail, based on their percentage of net worth allocated, has the most equity exposure they've ever had. Similarly, retail owns more equities as a percentage of GDP. I know it's kind of arbitrary, but they own more equities as a percentage of GDP than they ever have before. And in the past two bear markets, the great financial crisis and the dot-com bust, it was that component changing. Significantly more cash raised, even in 401ks, where people would just cash out their 401ks entirely. Not a good idea. Don't recommend doing it, but people do. And it's a powerful indicator. That, along with the Fed pausing on their hiking and looking at maybe loosening, those are the two things I'd look for as an end to this. I think we can get face-ripping rallies. We can get narratives that make it seem like we're in a new bull market again. But longer term, until those two things happen, the path of least resistance is lower. And when we look at this trend, when we look at this balance sheet trend here, we can see that they started pre-COVID at about 4.15 trillion dollars on their balance sheet. They worked that balance sheet up to almost $9 trillion. And we're starting to run it off little by little. I think Aisha did some research that showed that it was a rate of about $17.2 billion a month on the Treasury securities side going into September. And at this point in September so far, it's just over $20 billion. And again, on that Treasury side. And so we're starting to see them increase that run rate. But here's the thing. We have so many underlying components that are changing the demand supply structure in Treasury debt. The Treasury is issuing 2.5 times more debt this quarter, and similarly, we're probably going to see some size like that next quarter on account of more spending bills, higher interest rates, and the Fed no longer subsidizing or monetizing the debt, because when they do QE, they're essentially paying back the interest at the end of every year. So the Fed gives them a sort of interest rate-free Visa card, and they're able to use it to all the spending, and then they don't have to pay the interest because it in effect goes right back. That's all ending. And so not only is the cost to carry debt rising across the yield curve, but also what they pay for debt in terms of the Fed no longer being this sort of outsized holder of their debt. As time goes on, it's shrinking and shrinking. That's also changing, and then they're spending more money. Then at the same time, we have large foreign counterparties like Japan and China pulling back So all of this happening means the path of least resistance for rates is materially higher. And so the Fed has just started running down their balance sheet, and we've had one of the worst starts to a year. The first half was one of the worst starts in 50 years for the U.S. bond market. This year so far, global bonds have been having their worst year so far since, I think, 1942.